Daily mortgage rates, mortgage calculator. We will wait just a couple of minutes to get started here. We have the chat up on the screen. Feel free to drop a comment in the chat while we wait here. Good morning, everyone. Just give us a second here to go live on all of the different platforms. Give everybody a chance to tune in. Good morning to everyone dropping comments there in the chat. Adam, both Adams, Matthew, Mark, Nick, Julio, Mercedes, Geneva, the mortgage calculator team tuning in. Good morning, everyone. Happy Monday, ready to get to it here, a new week. Perfect week to close some loans. And today we got a great topic, always a good topic, especially for us here at the Mortgage Calculator that we'll get into here in a little bit. All right, looks like we are live on all the different platforms, so we can go ahead and get started. So welcome everyone, my name is Kyle Hiersche. I'm the COO of here by our president, Nick Hiersche, and our sales manager, Jose Gonzalez. On this show, every weekday, we go through the live rates of different mortgage programs, and then we do today's deep dive is something that we're very familiar with here at the Mortgage Calculator because we are a correspondent lender that specializes in non-QM loans and investor loans. So today we're going to be talking about fix and flip loans. So Jose's got some quotes. We're going to pull that up a little bit later and do a deep dive into fix and flip loans. But before we do that, just like we do every morning, let's go ahead and use our pricing tool to pull up the live rates for today. So Nick, why don't we go ahead and pull them up and see what the market is looking like this morning?
All right, let me switch to my other screen here and we will get started. All right, as Kyle mentioned, this is our pricing tool for our team of mortgage professionals. If you would like a full breakdown of a full loan estimate of all the details and costs, please get with our team. We have over 300 loan officers in 22 states for primary and secondary homes, and we can do our fix and flip DSCR business purpose loans for investors in 44 states. This tool will show us the general rates and APRs for our programs. So if you'd like that full breakdown, please get with the team. It is May 15th, just after 11 a.m. Eastern, so we have some rates that are live today for most of our standard programs. So we're going to go ahead and check out the rates this morning with a standard scenario. We're going to set the loan amount to $400,000 for all of our demos. We'll slide the LTV to 80% loan to value, 20% down payment for all of our demos. We will set the desired price to $99. That means we're going to ask the computer for the best rate at one discount point in cost, since most customers ask to buy down the rate a little bit. We're going to compare our conforming conventional programs to our FHA programs, and then we'll check out our expanded guidelines, aka non-QM, where we have over 5,000 additional loan programs beyond what you see here. We do have VA, but that's only for our eligible veterans. So if you are eligible, we appreciate your service and we'll be happy to quote that for you, but not everybody is. And same with USDA, that is only for properties that are in a USDA eligible area. If you do happen to be shopping there, let us know. We'd be happy to quote that, but not everybody is. So we don't do that live. So we'll start with conforming conventional. We'll set a purchase transaction, 30-year fixed, standard loan, primary occupancy, single family home, 1 unit, state of Florida, Miami-Dade. Estimated FICO for all of our demos today will be 760, and the estimated debt to income ratio that we'll set for all of our demos today will be 40. So using these basic setups, let's go ahead and check out our rates this morning. So it looks like a little bit higher than it was last week. Hopefully we see some more downward momentum later this week. But right now, the best option the computer found, 6.625 rate for 0.875 discount points and costs, and a final APR of 6.797. So that's a great option for our customers looking for conventional. Definitely tune in as we monitor it this week with a lot of announcements going on. But let's go ahead and compare our FHA programs this morning with the same exact scenario. So I'll set this back to 80, set this to FHA, and everything else will stay the same. That way we can compare apples to apples for the FHA program and compare the APRs for these programs. So FHA went up a little bit as well. Let's see, the best option's actually right here at the bottom. 6% rate, 0.875 discount points and costs for a final APR of 6.598. So a little bit higher than it was last week. Definitely recommend our customers out there shopping, lock in those rates here now. But as you can see here, 6.5 something, still just a hair below the conventional in this option. So FHA is typically for our customers that don't quite qualify conventional. FHA is usually the next option. But actually in this scenario, for this customer with the reduced FHA fees, the APR is actually a slight bit lower here. So actually a little bit cheaper. So definitely recommend our customers out there looking at conventional also consider FHA, as it could actually be a little bit cheaper in this scenario. Now, if our customer doesn't qualify for conventional or FHA, many other banks and lenders don't have other options, but that's where we love to come in at the mortgage calculator with our additional expanded guidelines, aka non-QM, where we have over 5,000 other loan program options besides what you just saw. So a lot of different options here. We'll keep everything else the same. However, when we have non-QM, we have our income verification option that we can select. So typically full doc is what we use for conventional and FHA. So we would usually not use that when we're selecting these non-QM. We'll typically go for one of these alternative doc programs, such as our asset related programs, our business bank statement programs, our investor programs for investment properties we'll talk about in a minute. Our personal bank statements are most popular. We have VOE, 1099, P&L, all kinds of different options. For our demo today, we'll choose personal bank statement 12 months. And that's for our self-employed borrowers. This is our most common request. Many times our self-employed borrowers, when they have 2 years of tax returns for a conventional loan, have various write-offs and may not qualify for as much income as they wish, and therefore either can't qualify at all or need to qualify with more income to get the home they want. So in this case, we're going to, instead of using tax returns, we're actually going to take their last 12 months of bank statements to determine this debt to income ratio of 40% using their actual cash bank statements rather than their tax return. So many times our self-employed borrowers qualify where they want to qualify before and typically qualify for much more income and therefore a much higher loan amount when they're using their bank statements. So these are great solutions when our customers need help. So let's check out our bank statement options this morning. These rates are going to be a little bit higher, but you see they're very comparable here. So the best option here, the computer found 7.125 rate for 0.875 discount points and costs and a final APR of 7.201. So the APR there, as we compare across programs, it's a little bit higher than both FHA and conventional, but remember this is for a customer who would not otherwise qualify for the home that they're looking at. So these are great options. We have a ton of different versions of these bank statement programs. Please get with our team. They can navigate which one of these may work best for you. Some of these may allow things like a bankruptcy, foreclosure, and other ins and outs of these programs that we can help you with. So tons of different options here to provide solutions for our borrowers. Now, before we go into Jose's deep dive, we want to check out our investment property rates. So we're going to go through some standard investment property scenarios right now. Jose's going to go into a deep dive on fix and flip, which is a very unique subset of an investor loan. But let's go ahead and check out our live rates for investment properties first. So we'll set this to the same LTV, 80% loan to value, 20% down payment. Everything else will keep the same besides investment property. And we're going to compare our conforming conventional investment property rates to our expanded guidelines for investment properties. Remember, FHA, VA, and USDA are not eligible for investment properties, so we simply compare these two options. So we'll start with conforming. We're going to keep everything else the same as our other demos. The only thing we changed was the occupancy to investment property. So let's check out the investment property rates this morning. A little bit higher than it was last week as well. So usually tracks in line with the other programs. So best option the computer found here is actually this one, 7.125 rate for 3.125 discount points in cost and a final APR of 7.372. So the GSEs that operate the conventional loan programs have added penalties for investment properties. So as you can see, there's no one discount point options here for our investors. Many times our investors want higher rate options for lower discount points, but there just really isn't any for conventional. So that's where we love to present our non-QM options. So let's go into our last live demo. We'll go to our pricer, set it up the same, go for investment property. And now we're going to click on expanded guidelines, aka non-QM, where we can find options for our investors that will have a little bit higher rate with less costs so they can save money for other investments. So we first have to select our income verification. Our most popular option by far for an investment property is going to be our DSCR program. That stands for debt service coverage ratio. That's because it doesn't actually require any income or employment from the borrower. We're simply going to use the estimated rental income from the property we're purchasing and going to determine if that can cover the expenses of the mortgage we're proposing, the PITIA of the mortgage. If the rental can cover the mortgage expenses, if the estimated rental income cover, that's a ratio of 1.00 or greater, aka the property cash flows, and we have a ton of options for DSCR programs greater than 1.00. And we even have options for a DSCR ratio under 1, meaning the property doesn't quite cash flow on a monthly basis, but there are still options for those as well. For the demo today, I will delete that so we can see all the different options that pop up. And for the final thing we have to set is our prepayment penalty. That is standard for a non-QM investment property. 3 years is standard. That's what we always use. We can choose 0. That will cost more and limit the amount of loan programs we can select. And we can also choose 5 years, but not all the programs allow 5 years. So that will limit the amount of programs, but it does save us some money in some cases. So we always choose 3 years because that is the standard prepayment penalty. So with these settings, let's check out our DSCR rates this morning. So good option here at the top. Actually, this one is a tad bit cheaper, 7.5 rate here for 0.725 discount points and costs and a final APR of 7.571. So notice the conventional APR was 7.2 something. Now we're here with a DSCR, no income, no employment. Our investors can start 1, 2, 5, 10 loans at a time to cash out, refinance, and purchase other investment properties. So a lot of flexibility and almost the same exact cost for our investors. So our investors love these programs. As you can see, there are a bunch of different variations. This is pretty much the same program, but with just a slight variation on how high the DSCR ratio is, aka if the property cash flows stronger, we can save a little bit of money. And there's a ton of options that you see here that we have for different prepayment penalties and all kinds of different options under DSCR. So please get with our team. They'll find the one that fits best for you. Now, a lot of our investors that are going for these DSCR investment property loans are very often coming off a fix and flip where they've actually fixed up an investment property. And instead of doing a purchase like we have here in this proposal, they're looking to do a cash out with the investors for their fix and flip that is now complete. So this is a very common tool that we use after the fix and flip. So now we'll have Jose present some of our options for the actual fix and flip. So let me switch my screen real quick and we'll talk a little bit about today's topic. So fix and flip loans, a very unique subset of our investor loans. A lot of people know about fix and flip. It's a very popular term. There are some misconceptions though. So I hope Jose can tell us a little bit about what is a fix and flip loan and where they're used. And then as we mentioned, typically our investors that complete their fix and flips and are ready to go into a long-term loan, the DSCR that we just presented is usually the number one option. So Jose, why don't you tell us a little bit about the fix and flip programs if you're ready.
Absolutely. Good morning, everybody. Thank you for joining us for Daily Rates Live with the Mortgage Calculator. Now, fixed flip loans are for investment properties only, right? A fixed flip loan is not a rehab loan for a primary or second home. Basically, it's a property where the loan is going to lend you the money for the purchase, not 100% of the purchase, but it will lend you money for the purchase, and it will also include money for the rehab portion, which will be disseminated through draws. So it's not like you're going to get 100% of the amount at closing. You're going to get enough for the purchase, whatever is agreed upon based on your experience level, credit, and other factors of the deal. The main factor to be taken into consideration with the fixed flip loans is, besides experience level of the investors, the profit margin in the deal. A fixed flip loan does not take into consideration any income of the borrower. Typically, on the fixed flip loans, you will have a separate contractor from the investor, but it is not a requirement. The investor could also be the contractor if they have enough experience for the fixed flip loans. They will let them do that. For the one-time close loans, for example, which are our primary and second home option for building a home, you have to have a separate contractor from the person who's actually getting the loan, because those are for primary and second homes. Those are not for investment properties. So like Nick was saying, fixed flips are great because usually they will get the fixed flip for the purchase. Usually they get 100% of the rehab, and then they go into a DSCR loan if they're planning on keeping the property, or they just sell it. So one of the things to consider with the fixed flip loans is the experience level, like I was mentioning, of the investor. That and the profit margin on the deal, and credit, of course, are the three most important factors. Not, your borrower could have, make $1 million a year. That's not going to have any bearing if there is no profit margin on the deal. So in the first example here, I have an experienced investor that has 10 plus flips in the last 3 years, 800 credit score. So in this scenario here, let's flip down a little bit here so I can show you the deal. We have a purchase price of $150,000. We have an after repaired value of $300,000, right? And we have rehab of $75,000. So we have as is value 150, purchase price is usually the as is 150, 75,000 in rehab, and we have a $300,000 ARV, or after repaired value. So roughly $75,000 in profit. So what is the deal that they offered us? The deal they offered us is total loan amount. And let me see if I can make this a little bit bigger for you all. Okay. Total loan amount of $202,500. Of that, $127,500 is for the, as they call, the initial advance. That's going to be for the purchase, right? So, and notice here it's an 85% loan to value, and they are financing 100% of the rehab. So 85% loan to value, 100% of the rehab. Pretty good deal. Now, there's some other factors to take into consideration here. Our down payment then is $22,500. They do require a liquidity buffer of 1.5% of the loan amount, $17,292 in debt service. So we have a liquidity requirement of $50,900. That's what our borrower has to show that they have available in the bank. So mind you, this is for our investor, experienced investor, 10 plus flips. And I did it.
What was the rate?
The rate. I was about to say that. I was about to say
it didn't copy in that other sheet. There you go.
Yeah, 10.24% is the rate. So that's a very good rate for a fixed flip, interest only, right? So this is our best case scenario. Super experienced investor, right? 10 plus flips in 3 years. That's amazing. So now we go to our investor. He has one under his belt in the last 3 years, right? And here's the difference. Not much of a difference, actually. The other one was giving us 202,500. This one is giving us 191,250. So at 77.5% loan to value, they're still doing 100% of the rehab. So it's $116,250 at closing for the purchase, and then the balance, which is the rehab, is paid out in draws according to whatever the draw schedule that you have agreed upon. So, and again, here our rate 10.99. So besides getting dinged a little bit in our liquidity, in the loan amount, we also have a little bit higher rate. But remember, in these loans, really the rate is really not such a big factor because it is a short-term loan. You're paying interest only, and many times you can even get the interest payment built in if there is enough meat on the bones of your deal. So you see here, same good credit for the borrower. The only difference is just in the amount of experience for the loan to value. So now,
We had a good question pop up here, Jose.
sure.
Can you go over the term on these? These are 12-month is pretty much the standard
Yeah,
term.
yeah. 12 months. I did all these quotes at 12 months. You can do, up to 24 months. It really does depend on the extent or the scope of the work, right? I mean, they're going to look at it. Obviously, all of these deals are reviewed. The renovation amount is reviewed. They make sure it's enough for what you're going to do, and then they look at the time frame. They obviously they don't want you to come up short, but at the same time, they don't want it to be overextended. So just keep in mind and that does happen when we get the fixed flip refis, right? Which is the next examples that I have. So for the fixed flip refi, now this is a cash out refinance, and this is our inexperienced investor, right? So he's getting.
Can you explain why they would use the refi version of the fix and flip first, just to make sure everybody understands? This is typically property they may have purchased cash at an auction or something. Is that what we're going for here?
Correct. They may have put some of their own money into it already. In this example here, I have our a borrower. He already put $25,000 in renovation.
This is a partial rehab.
Yeah.
Gotcha.
This is one of those that it's scary. It's hard to place sometimes because remember, we're going now to try to place this loan on someone who's already run
out of money.
He's already gone through the first loan. He's realized, oh my God, okay, maybe a little bit more than I thought. So let's cash out. Let's get a refi. We need more time. This is usually what's happening here. That note.
So this is basically an option to extend his hard money in this scenario.
Correct. Gotcha. Okay, that is what we're doing here. And he put money into it. He's hoping to get a little bit of money out of it, possibly to help him with the same deal itself. But here in this example here, our inexperienced investor, okay, he owes $100,000 on this property, right? He has $100,000 loan already. He put $25,000 into it already. He has another $75,000 to go, right? And he's paying off $100 to begin with, right? So they're giving him $90 at closing. So mind you, he's gonna have to pay 10 G's out of their own pocket to make up the difference for the 100, right? So they get 90 out of their own pocket, and then 100% of the 75 that's pending, they get financed, the rehab portion, right? So in our example here, our rate is 10.99. So that's pretty good. 10.99 considering the kind of deal that we're talking about. It is the same deal of a $300,000 ARV. They purchased it for $150. It's worth $150, but again, he owes $100, put $25 into it, and has $75 more to go. So that's what they're offering him. So 10.99 there. Now, our experienced investor does the same deal. The leverage doesn't change, right? $90,000 on the initial advance. The only thing that's really going to change here is going to be a quarter percent of the rate. Not a big difference. However, I did run the scenario with the investor only having one flip, and it did not qualify. They needed at least three or more in the last 3 years to be able to do the cash out refinance of the flip, because it is what it is. I mean, it's a high risk deal. The first question that would come to mind is, why are you doing a cash out refi on a property that was supposed to be finished already? Right? That's always going to come into play. What's going on here? Did you just mess up? I mean, did you open it up and find out more damage? A lot of questions that would need to be answered that could be potential pitfalls.
Cool. We got some questions in the chat. Looks like a couple you did touch on the length of loan. You just want to run over that one more time? Levine is asking about length of loan. So,
yes, you could have anywhere from 12 to 24 months term on these loans. I mean, obviously, they're going to really look. If it's not a lot of scope of work and you're asking for 24 months, they may come back with a counter offer of less months. Keep that in mind. I mean, you don't always get what you want in these scenarios like that.
Mm-hmm. And Ben is asking, can the borrower be a first-time investor at no primary home? We do have a couple options, but I don't think you presented those, correct?
No, I mean, I didn't. I mean, I presented the limited experience investor with 1+ flip in the last 3 years. We do have options for zero experience. They don't have to own a primary, but it's gonna be a limited leverage situation. The rate obviously is going to be higher.
Higher rate, yeah.
Definitely limited leverage situation. But we have them even for ground up construction with no experience. Again, lower leverage, higher rate, but we do have those options.
And we have them for foreign nationals too. A lot of foreign nationals are, not usually thinking they can get a fix and flip, but they do offer those. A little bit harder to prove experience, right? Unless they've done projects in the U.S. But in that case, they could still come in with no experience and still get one. Here we go. Another question from Nick. Can a brand new investor co-borrow with an experienced investor to satisfy that requirement? That's a very common question.
Yeah, that is a great question. We do have a lot of joint ventures that occur with fixed flip loans. And one of the good things to note that usually, obviously, you got to confirm this with whoever you're submitting the loan, but usually on the fixed flip loans, they will let you use whichever member of the LLC you want to use for the loan, right? They're going to be the guarantor, right? So you could pick the person with the highest rate, with the highest FICO score, and just apply with that one person, and it'll be perfectly fine. Even if you have 2-3 other members of the LLC, they don't have to be on the loan. Whoever gets put on the loan is the credit score that will be used, and that is also used to solve experience requirements as well. You have 0 experience, but you JV with someone that has 10, and they sign the application as the guarantor. Now your deal has 10 flips experience level, and you're going to get the good pricing and the good leverage.
All right.
Looks like another question here.
Yep. Levine has one more question. Does the use of a general contractor, I guess, if used versus self-renovation matter when obtaining the loan?
Well, I mean, it always matters only to the extent that they have to vet the borrower, right? That's one part of it. They have to vet the contractor, and they have to vet the renovation portion, right? So obviously, I mean, it's not going to disqualify you, but there are additional requirements when you are the self-build investor. They are going to be a lot more stringent on the experience level. You're not going to be an inexperienced investor and come in and do that. You could be a very experienced contractor, but those don't necessarily count as experience notches on your belt as far as fixed flips. So yes, you can use it, but it's definitely going to add another review that's going to have to be met by the borrower in order for the loan to be approved.
All right.
Looks like that's
Looks
it.
like we can go ahead and definitely something great that a lot of people, as Nick said, may have some misconceptions about or just need more info about. If you're looking to do one of these fix and flip loans, you can visit us at themortgagecalculator.com, info@themortgagecalculator.com. We can pair you up with one of our loan officer consultants that can walk you through this different process with all these different programs. Now, we do this show at 11 a.m. Eastern every single weekday where we go through the live mortgage rates, and then we do a deep dive just like we did today with the fix and flip. Definitely tune in every day. We'll see how the market goes up and down. Thank you, Nick. Thank you, Jose. Thank you, everyone, for tuning in, and we hope to see you tomorrow of Daily Mortgage Rates Live with the Mortgage Calculator. Everybody have a great day.
Thanks, guys.
Thank you, everybody.